Okay, well, welcome everybody. Good afternoon. Welcome to a brief history of an introduction to blockchain and cryptocurrencies. This is the first in a series of webinars aimed at unraveling the complexities of cryptocurrency and blockchain. As James said, I'm Charlie. I'm the community manager here at New Future Foundation. This is James, our host today, CEO of New Future Foundation and part of the fund management team at the Digital Future Foundation. If you have any questions, pop them in the chat and we'll aim to answer them towards the end. If you have any questions after the event, feel free to contact me and I'll get back to you with the answers. I really hope you enjoy the session. I'll hand you over to James to take us off.
Thank you. We'll make a start. Thank you, Charlie, for the intro. So, as alluded to, the event today is brought to you by the Digital Future Fund and the New Future Foundation. The New Future Foundation runs events on entrepreneurism, transformational technologies, and thought leadership about business and social organization in the future. So you can subscribe to that to become a member and don't miss out. The Digital Future Fund is an exclusive membership community running more interactive events with Q&A, discussion, guest speakers, meeting in real life, and international trips to go and visit some of these exciting startups and companies and get inspired. You can visit the website to register there, declare that you qualify as a member, and partake in that way as well. Just to make absolutely clear, this webinar contains no financial advice. I'm not a financial advisor. We're not regulated financial organization, and crypto assets are highly volatile and unregulated space. So if you invest in them, you run the risk of losing all your money invested. So take that as given for now. Now to the presentation. This presentation is really there designed to help you understand where we are and where we're going with blockchain and cryptocurrency. And I think in order to do that, first we need to understand where we've come from. So I'm going to tell a bit of a story today, a story of the history of crypto and blockchain, how we got to where we are, and try and identify through that what and why it is so very important. Now, the tale of blockchain and cryptocurrencies is a tale of multiple technologies with a longer history that have come together over a period of time to enable one very important part of the great transformation that we're in the midst of from an analog age to a digital age. 1 in 5 people in the UK have bought or owned some cryptocurrency at some point, and yet almost no one really knows what it is or why it exists. I spent 20 years learning about technology and communication trends and communicating it to people and, helping them use it. And, this is a particularly complex one, believe me. And there is a lot of hype and misinformation out there, and it can be overwhelming. And by telling you the story, I hope that you'll understand where cryptocurrencies sit in the wider context, to try and understand that the long history, they didn't just appear overnight, although they appear to, and they're not that exotic, but part of an ongoing evolution of technology and digitization of society, and how we respond to and fix the impact of this digitization. And in future events, we're going to delve more deeply into specific topics and issues. But today, as I say, is all about having confidence that it isn't smoke and mirrors, it's not pure hype and nonsense, and there's a real solution to a real problem with a good historic context behind it. Now, in the tradition of great stories, from Homer's Odyssey to, of course, Quentin Tarantino's Pulp Fiction, I'm going to start this story in media res, right in the middle, at its most dramatic event. And that event was the 2008 crypto crisis. Cryptocurrency is a technology born out of a moment of crisis, and the subprime mortgage collapse caused a ripple effect that essentially crashed the whole financial system, creating an impact we still feel today in national debt, attitudes towards the banking industry, regulation, and many other areas. I'm sure people on the call may still feel the sting, and the attitude of negativity lives on in public opinion. There was a lot of vitriol and anger that it could be allowed to happen, that a small number of people could be irresponsible, corrupt, or unreliable to do that to so many, and that they would be let off the hook with everyone picking up the bills through taxes. Now, whether you buy that story or not is kind of irrelevant. It is one that dominates the public perception. And on the back of that feeling and sentiment, on the January the 3rd, 2009, an anonymous developer called Satoshi Nakamoto made history when he released the Genesis block, the original block containing the first 50 Bitcoins. And unlike any of the 500,000 or 500,000 odd blocks that have come since, Nakamoto left a message on that block. The Times, 3rd of January 2009, Chancellor on the brink of a second bailout for banks. And that was the headline on the paper that you see in front of you, the London Times for that day. Now, whilst Nakamoto did not clearly state the meaning of this message, many have interpreted it by reading his other comments and forum posts and comments by those around him as a reference to why Nakamoto developed Bitcoin, to cut the banks and the middlemen out of what he saw as a corrupt, unreliable system, and electing to create a more people-driven currency. Now, I know what you're thinking. First question everybody always asks about is, who is Satoshi Nakamoto? Well, he's a mysterious figure, I'm sure you've heard. Nobody really knows who he is. He disappeared at some point. We don't even know if he really exists. There are quite a few posts by the name in the early stages, but nobody really knows. My opinion, and it is mostly a hunch, is that it is a pseudonym for a group of developers who worked on it together. But there's lots of opinions. Maybe you've got a view and you want to share that in the chat. So here it is, the blockchain software and database, where it was launched, looking just like any other executable software application, released on a platform called SourceForge. This doesn't exist now, it got hacked. Well, it does exist, but you can't use it. But the source code is now managed and maintained by an organization called bitcoin.org. And the way it was released is important. So it was released as open source code, Bitcoin 0.1 on the 9th of January. And this is a key part of the top technology message. So the open source initiative is an organization that manages the open source definition and manages licensing rights and that for open source software. It's based in California. It's been around since 1998. And the idea and benefit of open source is it enables developers to kind of harness the power of peer review and working together in big, transparent, collaborative groups. The idea is you get higher quality, better reliability, greater flexibility, and lower cost software, and that you're not locked into a specific vendor. Now, you can debate whether that's actually what happens with open source a lot, but one key feature that does happen when it's open source is you get a lot more people involved and it moves a lot faster because it's democratized and free to all. And that allows it to accelerate really fast and benefit from the network effect of so many contributions and to evolve fast. Another technology that was launched open source, this time based on protocols, was the World Wide Web, Tim Berners-Lee, and it grew like it did because it was free to use. And exactly the same applies to crypto and blockchain now and how it exploded into our lives. So a few days after the launch, on the 9th of January, the mining of the first Bitcoin blocks officially began. And the first transaction, which occurred between Nakamoto and a chap called Hal Finney, who was a member of a crypto-anarchist movement, took place. And the first price of the first transaction, calculated by the New Liberty Standard, which was basically the cost of electricity to generate or mine the currency, was set at 1,309.03 Bitcoin to $1 US. Today, the price of a Bitcoin stands at about £31,000, or it did this morning, or $42,000, and a $1 investment then would now be worth over $56 million today. And there are many stories of people who have been on that journey. In 2009, a gentleman called Christopher Koch purchased 5,000 Bitcoin for $27. He forgot about it. It laid up for a few years in digital space. In 2018, that was worth $39 million. Another funny story is for the Coinbase investors. For those of you who don't know, Coinbase was the first, or it's not the first, it's one of the most highly used, easy to use mainstream exchanges for buying and selling and accessing the crypto markets. It recently floated on the stock exchange in the US, but if the Coinbase investors had just kept their money and invested it in Bitcoin, they'd have more value now than the company is worth. The total market cap for all crypto is around $2 trillion US. And year to date, the growth of Ethereum has been 295% since January of this year. Cosmos Atom, 489%, and Polkadot growth, 356%. At the same time, central banks from the ECB to the Bank of England to the Fed are all planning CBDCs, or central bank digital currencies. And the ECB announced this week they expect to have something within 5 years. So all our money and all our transactions stand to be touched by and transformed by this. How did that come to be? In a little over a decade, 12 years, from nothing to this huge asset class, so much money and such an important part of our lives that potentially will touch us all. It seems to have come from nowhere. Well, of course it didn't. And to understand where it really came from and why it's important, we have to go back to the earliest days of the internet and introduce two more technologies that are much longer standing. And like most great people or great things, obviously Bitcoin stands on the shoulders, and the inventors of Bitcoin stand on the shoulders of those that came before. And the two key technologies that needed to exist before crypto and blockchain could be evolved were these: cryptography and peer-to-peer file sharing internet protocol services. And these have been around for a long time in their own right. Cryptography is as old as civilization. The Egyptians and others were using cryptography for ciphers as early as 1900 BC. Modern crypto analysis evolved in the UK at Bletchley Park during World War II and was in response to trying to solve the ciphers carried out by the German army during World War II. This actually culminated in the development of the Colossus, the world's first fully electronic digital computer, which assisted in doing that. So you could say that computers, modern digital computers, came about because of the need to develop cryptographic digital techniques. And in modern terms, cryptographic keys and hash functions are fundamental elements of how crypto and blockchain technology works. And they've developed over decades of use before the advent of Bitcoin. Peer-to-peer, on the other hand, is as old as computing networks. And essentially, when two node members of a network can communicate with one another without having to pass through a specific central point or intermediary. The basic concept of peer-to-peer computing was set out in the earliest development of the internet and networking discussions, and is involved and written in the request for comments as part of the first ARPANET stage of development. And the ARPANET was the precursor to the internet. And Tim Berners-Lee vision of the World Wide Web was as close to a P2P network of web links as you're going to come in your life. So P2P is used in many forms since, and I'll talk about some of those examples today and the different ways that people have gone about trying to use these technologies. These technologies were seen as ways to solve problems that the founders of Bitcoin were ideologically and politically opposed to. Problems that existed in the analog, the real world, but were either compounded or perhaps could be solved in a digital context. And in 1988, American Tim May, a senior scientist at Intel, set out the Crypto-Anarchist Manifesto. It highlighted many of the concerns him and his peers shared about the digital world, and there's lots of articles and information around this. It developed into two related movements, crypto-anarchism and cypherpunk. But fundamentally, the concerns that they were focused on were being anonymous, the ability to track an individual, and the ability to see what they're doing, freedom of speech and freedom of trade. It was, in general, a reaction to the ability or potential with digital to monitor and coerce individuals and members of the population. And Satoshi Nakamoto, in his white paper, and a white paper, by the way, is a document that you write when you're planning and publishing and thinking of creating a blockchain, conveying similar ideals to those. And these ideals are quite closely related to the libertarian movement, a movement focused on individual freedom, autonomy, and freedom of trade and free market economy. Most pertinent to this story, the association with free market capitalism as an ideal. So Nakamoto wanted to enable individuals to freely communicate with anyone they wanted without external control or being censored or refused or even taxed. He also wanted to empower individuals to join or leave communities without having to prove who they were to a central authority. Now, Nakamoto makes explicit reference to this in an email sent just before the release of Bitcoin, where he says governments are good at cutting off the heads of centrally controlled networks like Napster, but pure peer-to-peer networks like Nutella and Tor seem to be holding their own. So we can see that in the development of Bitcoin and crypto, it is closely related to trying to solve what some people saw as fundamental problems in a digital society and a digital economy. And as I said, there were loads of attempts at that. eCash, developed in 1983 by David Chalm, used cryptography to secure anonymous payments. That went on till 1997 when it collapsed, shortly before PayPal was set up, interestingly. eGold was a system set up and launched in 1996. At its trading peak in 2006, it was trading around 2 billion worth of transactions a year. But that was shut down by the US government as it was highly monopolized by criminals, and there were fears over security. Excuse me. And it's not just money that these technologies have been applied to try and solve. So security of data, privacy and anonymization as well. Tor, or the onion router, is a technology that uses a network of 6,000 relays to try and allow you to browse the internet without being tracked. It uses a technology called onion routing, which is a peer-to-peer network. It's been around since the 1990s and is still going today. Onion routing, interestingly, is the basis for the dark web, worldwide pages where you don't know the source of the author and cannot be easily traced. As a result, it does attract nefarious characters, drugs, and illegal activity. It also provides a vital service for those in politically challenging situations. And the World Wide Web as well, in its very early stages, had a lot of the same characteristics of usage. I2P, the Invisible Internet Project, founded in 2003, again uses similar technologies, this time to protect anonymous file sharing, and that too is still running today with lots of applications on it. And one of my favorites is Napster, if you remember Napster. Founded in 1999, it was a peer-to-peer file sharing network that emphasized sharing music in MP3 formats. And back then in 99, I was a politics and philosophy undergraduate. I also did a bit of student radio. I thought that was cool, and spent many hours planning and downloading my music from Napster. So it brings back good memories of burning out CDs and mini discs. But Napster didn't last. It had a point of failure. It was centralized, and so it was able to be brought down. What it did do, though, was herald a major crisis in the music industry that continues today, whereby artists struggle to monetize their recordings and their content. And so they have to tour a lot more, and they just don't make the money out of it they used to. But interestingly, there are projects going on, and I've been involved in a white paper and a prototype, which is a way to use these crypto technologies to re-empower music and content creators. So the technology that trashed recording artists' revenues could, in the future, re-empower them again. And so after a potted history and many uses of technology projects trying to address some of the same issues, we're back to 2009 and Bitcoin. And in the wake of the financial crisis, Nakamoto and the founders of Bitcoin set out to solve three key problems: protection or proof of identity through anonymity, or actually pseudo-anonymity, because it isn't entirely anonymous; disintermediation, breaking the reliance on a single point of failure or control; and trust, ensuring the validity of the decisions that are made, ensuring that they meet the expectations agreed upon by the members taking part in that transaction. They can't be faked, and they can't be changed or abused by a controlling influence. All of this in reaction to the 2008 financial crisis. And it was only in the 2000s that the technology was mature enough to be able to support this ideology. Had P2P and encryption not been around, it wouldn't have been possible, but there was a final part of the puzzle that needed to be developed. And this was distributed consensus, trust. This is Satoshi Nakamoto's true innovation, the consensus mechanism, which in this case is known as proof of work and is involved in the mining process. So whilst P2P or peer-to-peer enables anonymous or pseudo-anonymous transactions, it doesn't ensure trust or take out of the hands the management of a central point of failure. A trust in traditional organizations, in companies and governments is centralized. The question is, what happens to that trust? We need it to be able to transact and work together. But what happens when that trust in that central organization is eroded, or the polity or group is beyond the reach of any specific organization, i.e. it's cross borders and encrypted? These are all challenges that are faced by the digital world today. And distributed consensus takes this out of the hands of one central body and therefore avoids the problem. So there are many types of distributed consensus. This is one characteristic that is critical to the credibility and application of a blockchain, understanding how the consensus mechanism works and what its features are. Key consensus mechanisms that are used regularly include proof of work, mining, which you will know from Bitcoin is solving calculations. You get rewarded for doing so. And proof of stake, where someone places a token or something with some value on the line and they participate in it in the network. And you stand to lose it if you contribute poorly to the network, or you gain extra assets and resources if you contribute well. There are more types than you can imagine of consensus mechanism, and they're developing all the time. The second key distinction to understand a distributed consensus mechanism is to understand the difference between private permission and permissionless. So in a private permissioned mechanism, it's closed. It's like in a limited company. It's controlled like a traditional software asset. You can sell it, turn it into a product. You control who has access to it. In a permissionless one, it is open. Anyone can join the community. Anyone can participate. This is what Bitcoin and Ethereum and many of the others are. The thing with a distributed mechanism is that it removes that central point of failure and engenders trust, because no one has overall control of the decision-making process or network. And this isn't a new concept. It's as old as society and the economy itself. The oldest economic institution in the world, the City of London, grappled with how to manage trust in business. And if you visit the Museum of London on the Barbican today, they've got an innocuous old chest from the 14th century. And this chest was kept in the Guildhall in the City of London to store all the important civic documents, valuables, and seals. Now, by today's standards, having all your most important security documents in a chest in a Guildhall might sound rather precarious, but this chest was special. It was fitted with 6 locks, and each lock had a separate key held by an individual key holder. And the chest could only be opened by all 6 key holders at one time, 3 aldermen and 3 reputable men of the city. That meant no one person could be tempted or guilty of misusing these assets or gaining access to them. And in order for the City of London to function as a cooperative social and economic entity then, they used the technology available to implement distributed security. It was deliberately designed to engender trust and secure assets in the common interest. Now, this particular example is engaging, but it is not unique. Indeed, the history of human society is the history of human ingenuity, creating tools and techniques enabled to engender and enable cooperation through managed trust. And as a consumer or a business owner dealing with businesses and corporations today, when you interact with other companies, your trust is placed in their brand. Terms and conditions and contracts exist, but certainly from a consumer point of view, we're all guilty of clicking yes, 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 because they're too long and we just want to get on with it. Most of you simply choose to trust in the brand or in the company and the values and the behaviors it represents when you do these transactions. These days, we have computers, not chests. We have connected networks, and our most important financial and legal assets are recorded and passed between computers. But the problem of trust, security, and control and shared interests remains the same, except it's on a much greater scale. In a world of faceless, global, dehumanized, automated service providers, big platforms from Facebook to Google to TikTok, whatever you want, they transcend political borders. They're automated. They've got AI-driven tools. You don't even deal with a human at all. All of that DNA and thousands of years of trust-based skills that you have to look someone in the eye and shake their hands, or even to do a contract with them in terms of society, they just don't work at that level. And who acts as the arbitrator of justice when the polity in which you're operating is unclear, or the cost of enforcing your rights against a global, faceless, uncontactable giant is insurmountably high? But we still need keys, we still need places to store data and assets and ways to trust one another and work together. So how are the old tried and tested technologies of peer-to-peer encryption and distributed computing, together with open source, how have they come together to enable cryptocurrency to fix these problems for us today? Well, first I want to draw a distinction between cryptocurrencies and blockchain. Cryptocurrencies are enabled by blockchain architecture. All cryptocurrencies are based on blockchain, but not all blockchain applications have cryptocurrencies attached. Much of the tech and blockchain architecture can be used without a currency. These services can be packaged in a company and offered out, or you can download them and use open source versions such as Paxos. And you can solve many problems within the confines of legal and commercial structures of companies without having to be revolutionary or, to be financially or legally transformative. What this doesn't do, though, is it doesn't overcome the risks of centralized points of failure. And that is the critical difference in a global digital polity. And if we look at the stats, we can see that 62% of Americans think search and social media companies need to have more regulation. Almost 3/4 of people, are concerned or neutral about it. Thinking beyond that as well, in terms of the polities that manage and enforce these regulations, many of these governments are highly distrusted by the members of their societies today, and we've got a real issue with trust that these companies and organizations and governments won't abuse power, and that the cost of legal resource is so high that if we complain, nobody will listen. Without a technology such as this, all we can do in a digital world is cross our fingers and hope, unless, of course, we've got very deep pockets. So how does this technology work in practice? Well, some diagrams to kind of just give you a very brief overview. At the heart of cryptocurrency is a community. And this is a group of people who have an interest in solving a shared problem that blockchain and crypto is well suited to solve. They don't want to put the power or control in the hands of one individual or individuals. So giving you some examples, the problem might be in Bitcoin that they think the banks and governments, cannot be trusted to run the monetary system. Or in the case of Ripple, XRP, we need to make a new international payment system between the banks that is better. Everledger is an example of a limited private company working with diamond traders to manage the provenance of diamonds better. And in the case of Ethereum, this was developed by developers who wanted to build applications on crypto easier than you can do it on Bitcoin, hence the development of smart money and smart contracts. Now, the members of these communities choose a way of solving that problem through blockchain, and they design it and they agree the rules associated with solving the problem. That is the objective or mission of the blockchain. The members of that community then agree to take on a role maintaining the database or the ledger as software on a computer. And because it costs or requires work to do that, in return for doing it, they get rewarded. And this is where the currency and the tokens come in. So mining or staking is what's going on at this point. And this incentivization is critical in two ways. One, in return for effort and for reward for effort and taking part. And two, as an incentive to change from old behaviors and old ecosystems and old systems to join and adopt new ones built on blockchain. The network of members are often referred to as nodes. There are lots of different types. The more nodes, the more distributed and secure and robust the system is. Now, I'm going to apologize to any developers or architects that are on the call for my crude drawings, but I'm trying to make it as simple as possible. This is a little bit like what a node might look like for each member. It's a piece of software, and that member is either mining or staking or doing something else, and they're getting penalized or rewarded for doing so. As a community member on your computer, you have the software program and you receive some data from the community to be stored on the blockchain. In the case of something like Bitcoin, all it is the number of Bitcoins, who owns them, and how you move them about, who's bought them and who sold them. The coin doesn't actually exist anywhere. It's written down that it exists in the ledger, just like real money, debt that banks create. Your money, if you get out a note, it says, I promise to pay the bearer. It isn't actual value, just a promise of value. And that data is stored on the ledger, which is essentially just a spreadsheet or a database. Now, the spreadsheet in this case is broken into pieces or blocks, hence blockchain. And the size of the block is determined by the designer of the blockchain based on their need or their preferences. The data is then verified by a software program. And all the software program does essentially is check against the rules that the community have agreed and set in stone that the data meets those rules. Because it's done by a computer, you don't have to rely upon a fallible human. In Ethereum Classic, they have the tagline, code is law, because all of the rules are set in the code and they believe they're immutable. And even if there's a problem, you can't change them. But it's simply a software program that verifies the data. And sometimes it can be as simple as saying, this is the data, or it can be very complex and you can have smart contracts with lots of rules. Now, once the data is created, a hash is created, which is just a long stretch of numbers created using cryptography, and it is derived from the data. Now that hash is added to the bottom of the block and to the beginning of the next block. And the hash helps you ensure that the data isn't manipulated or changed, because the hashes would change and they wouldn't match anymore. So you've got them on each individual block and then copied around the community as well. And this helps make it immutable and secure. Now, when you're designing a crypto, two of the most fundamental rules you need to think about are money supply and inflationary and deflationary rules. Now, these vary, but for Bitcoin, for example, there is a finite supply of money. There is a finite amount of Bitcoin. It is spread over time, the supply of money, and over time it gets harder to mine it as the resource required to do the calculations increases. In XRP and Ripple, by comparison, all the tokens are pre-mined. There's a finite number. And in Ethereum at the moment, there are unlimited tokens, and the number is managed by the supply rate that is set by the community. But this is actually under review by the community right now, and Ethereum are talking about going to a finite supply. So the verifier software either verifies or rejects it. That decision is then submitted for consensus amongst all the other people that are on the blockchain. And this is the consensus mechanism. And it's how we come to a decision. And it can be done in many different ways, as I said, from a simple majority to sophisticated things like Byzantine fault-tolerant consensus mechanisms, which is a subject for another day. The members of the community get rewarded or penalized. And in order to that, they have to have something on the line. And in Bitcoin, of course, you're rewarded in Bitcoin. In Ethereum, you're rewarded in Ether. And that fundamentally is it. That is how a blockchain works. That is the technology and process. It's designed to solve some fundamental problems in the digital world, and cryptocurrencies, whilst, they're called cryptocurrencies, are actually better understood as financial instruments or tools, not currencies. And they really focus on doing three things and are defined really as any cryptocurrency operating through a distributed ledger. It must be doing these three things. One is pseudo-anonymity or anonymity, or managing privacy to some extent. And this is achieved through the encryption and the cryptography. The second is the disintermediation, and this is achieved through the peer-to-peer network, so there's no central point of failure. And thirdly, and for me, without a doubt, the most important piece is the trust. How do we ensure that we can trust the results, the correctness, the integrity, and the legitimacy of any transaction or data on the system without a third party or central authority doing this for us who can be compromised or who is open to influence? The distributed consensus mechanism is also what sets cryptocurrencies apart from standard digital money and e-money, because of this bilateral disintermediated way of working. And in the case of money, these things come together to solve the double spend problem of digital cash. And the double spend problem in digital cash is the fundamental problem with all digital assets, full stop. that you can cut and paste them, reproduce them as many times as you like. With crypto assets attached and wrapped into them, you can create scarcity, you can create value, and you can create a sense of uniqueness. There are two more key technologies that are kind of central to the ecosystem. One is an exchange, which is the way in and out of the network, where you can buy in and out of fiat cash. You can exchange tokens with other types of tokens, buy and sell them as well. This is a major point of engagement with the financial authorities. Normally now you will be required to do anti-money laundering or know your customer activity so they can identify you. This is because money can transfer across border quickly and it comes in and out of the financial system and is harder to track. The wallet is the other key bit. Ostensibly, it's where you hold your tokens, although as I've already said, they don't exist except as a record on the ledger. So this is where you can see them. You access that with an encryption key. Again, if you lose this key, your value stored in crypto is lost forever. You can't get it back. And there are many stories of people who have had thousands of Bitcoin and they've dug through rubbish piles, spend years searching for lost crypto keys in order to be able to do that. So governments and polities and central banks have spent time working out how to define cryptocurrencies. As I said, they're financial instruments, not tools and currencies. In the near future, smart contracts mean they might be legal instruments as well, but we're not there yet. In any case, it makes sense to start with the financial system since it was in reaction to the 2008 crisis. And this is where they've been applied most and are most mature. Also, as Simon Dixon points out in the book Bank to the Future, money's digital by nature. You know, in terms of the debt created and managed in banks, it all exists on computers. So making it, if it's digital by nature, making it digital in practice seems the logical thing to do. Interestingly, however, when you start to explore the use cases for blockchain and crypto, using it as a currency to compete with fiat, it begins to fall down. You know, for a start, it isn't government backed, so therefore it's not a fiat currency, full stop. But there are many other reasons as well. That's not for today, that's for another event, and it's really an interesting thing to dig into. One fundamental challenge that holds it back and is going to have a massive impact on the next 5 to 10 years of crypto is it doesn't fit neatly into a specific jurisdiction. They're borderless. Therefore, you can have different rules in China, America, Europe, the UK, everywhere. And at the moment, you've got China cracking down heavily on this, just as they have on the internet and Google in the past to have some control. But of all the legal bodies around the world trying to define it at the moment, you know, subject to lots of forces playing into that, protectionism, fear, innovation, opportunity, the Swiss authority is one of the most established. And they kind of talk about three types of core tokens, and you can see them there in the middle. Payment tokens, a unit of payment from one individual to another that you don't know directly. That bypasses any centralized financial intermediary. And there are examples of people buying products, placing payments. Someone bought a £70 million mansion in 2017. 22nd of May, many years ago, 22nd of May is called Bitcoin Pizza Day because somebody bought a pizza with 10,000 Bitcoin, the most expensive pizza in all of history without a doubt by today's standards. The second way that they used is that utility tokens. So this is a bit more like bartering. You can use utility tokens in exchange for a specific service or activity. So it might be contributing to something by reviewing content. It might be to use a piece of software or something like that, but you use it to do a thing. And then the third definition is crypto asset security tokens. And these are cryptos that can represent specific assets. So they're linked to things that have some inherent value themselves because they represent something scarce. Now, this could be a property, or it can be something like shares in a company, you know, the equity directly linked to the commercial value generated. You know, they're essentially similar to shares or bearer bonds. And there are many examples of this happening through ICOs and other things, other forms of activity as well. ICOs I'll explain in a minute. Ultimately, all these different kinds of tokens get their value in different ways, and they're all good at solving different types of problems in different contexts. And when you layer in all of the different ways you can build and use this technology, the opportunities are absolutely exponential. So a brief history kind of to things, fill in some of the dates between the start and now, just to give you an idea of some of the things that have happened. I've kind of broken this into 5 key phases. From the birth of Bitcoin, it was obviously born to try and fix issues with fiat currency. It's not been that successful at doing that, but it has been successful in a number of other ways in terms of censorship, resistance, speculation on price and wealth creation in a wealth store, being used in PR and marketing plays. People have used it to hedge fiat currency, and institutions and banks who initially laughed at it are now pouring money into it and storing money in it. And large companies are doing so as well. The first purchase of physical goods was the pizzas purchased in May 2010. And the first exchange was called MTGOX, which was founded in July of 2010 and became, really the only way to buy and sell for a period of time. In 2010, December was the last time we ever heard from Satoshi Nakamoto on internet forums. And by February 2011, a Bitcoin was worth $1. And that was kind of the first phase of growth, or what is accepted as the first phase of growth. And then it's kind of what is called the crypto Wild West phase. Now, this started with the first alternative cryptocurrency, Litecoin or altcoin. This was created and then in 2011, and by 2014, there were 15 different altcoins. It was a period of wild speculation, crazy schemes, and abuses of technology and nefariously illegal goings on. Lots of the infrastructure was built in this period as well. Wallets, Coinbase, BitPay, and Silk Road all came into being in 2011. Silk Road, as you know, is very famous for drug trafficking and things like that, and was shut down in 2013. It was very well adopted by nefarious individuals. In 2014, 70% of Bitcoin transactions were through MTGOX, and most of the transactions were related to Silk Road. But this is a pattern that the World Wide Web followed in its early stages as well. Soon after that, a lot of hacks began to happen. 850,000 Bitcoins were stolen from MTGOX, and the price of Bitcoin collapsed in 2014, and MTGOX was shut down. The next phase from 2015 to 2017 was really about the development of crypto assets and more altcoins. So people realized you could do more than just do currencies, and Ethereum was developed in that response. And Ethereum is also tagged sometimes as the world computer. A fundamental difference is that this token is linked to a smart contract, and you can put in lots more flexible things that you can do with it. And the different contract types are called ECR standards. So the main one is ECR 20, but there's lots of different standards. And you really begin to get the architecture of crypto assets mimicking open protocols and tech protocols in the wider world. So Ethereum led to the development of dApps, or distributed applications, software running on blockchains or applications running on blockchains that have the characteristics of them built in. And this led to companies being formed around these, and ICOs, or initial coin offerings. And these are basically like share offerings, but you get tokens instead. And they exploded in a massive way in this period. Lots of people made money and lots of people lost money. Another key date in this time was in June 2016, the hack of the Decentralized Autonomous Organization, or DAO. So the DAO was set up to manage crowdfunding for backing new Ethereum-based business projects. And DAOs are quite important. I'll talk about them again at another event in the future. But DAOs are a way of organizing a business or a group of people to make decisions that mean that you don't have to have a centralized leader or controlling in the form of an organization. So the DAO was hacked, $50 million of assets were stolen, and that led to a hard fork between Ethereum and Ethereum Classic. And then bring us up to date, we had the crypto bubble in 2017 when the price raised to $20,000 and then dropped back to 9,000. And after a period of long consolidation, it climbed again. And at the beginning of this year, we had another peak and a drop back. And so we look to the future and what's going to happen then. I think there's going to be what you could call a bit of a bubble bath. I think that I've no doubt that the future is positive and looking up. But, we're going to get bubbles in terms of lots of new highs, and we're going to take a lot of baths as well in terms of new lows. And I think the causes of those will be as new regulations are established and case law comes in, winning in some, losing in others. Mainstream adoption, lots of institutional money going in will drive value. Building financial tools and assets on crypto, the number of applications built on it increasing will drive value. And so I think there'll be a cycle of, personally, and it's just opinion, a cycle of boom and bust and growing pains caused by illiquidity, a lack of decentralization and regulatory setbacks. But it will also be a period of huge innovation and creativity, as the cowboys and the crooks and the fundamentalists get outweighed by the early adopter, large minority of innovators and entrepreneurs. A good way to classify it at the moment is to look at it as a world building itself. Most of the applications that are still being built are tools for crypto people by crypto as it builds itself out. But there are some real world applications that are very common now. So loans, peer-to-peer loans, insurance, asset tracking, infrastructure for stock exchanges are all coming online now. And there's many more as that goes forwards. I think you can classify, 3 stages potentially. One is a stage on building financial assets, debt and other bits after that. Another stage building on top of that are building out legal assets, smart contracts, digital versions of legal things. And then a third phase of building out a broad range of markets. And who knows which of the technologies will be the ones that are ultimately the ones that make it through. You can look at the fundamentals and really understand that, but this is all, future gazing into the future. So we're kind of at the end now of the talk, and we're going to do some questions if anyone would like to ask any in a minute. But I fundamentally think the next 5 to 10 year horizon is pretty special, potentially epoch defining. Every single central bank is exploring CBDC, central bank digital currencies. And I would end by saying how I think it'll unfold and why it is very important. My best guess anyway. Crypto-like and blockchain-like family of technologies, the technologies like it, that provide the technology of trust in a world where our traditional tools of trust do not work because interactions are disintermediated, digital and distant, will become more and more important. We have a need for those checks and balances. We've needed it throughout history, and we'll need it now and into our digital future. I also think fundamentally, crypto provides a more human and natural way of organizing, which sounds bizarre, given how exotic and unnormal it seems. But in the story of mankind, we spent most of our time, the overwhelming majority of our time, in decentralized organizations, transacting peer-to-peer in barter-based economies. We only centralized because we had to, in the 16th and 17th century, because of the scale and complexity of societies as the population rose. It was a necessary compromise to manage living with so many analog humans. Before that, we bartered, and digital automation plus blockchain, the ability to do thousands of transactions at speed and to do them, with different matching pairs, that family of techs allows us to move back potentially to that way of peer-to-peer transacting. And changes in the global economy show a trend in that direction. So the emergence of platform-based businesses like Airbnb, Uber, peer-to-peer relationship-based platforms where I deal with a third party via a platform. Given the choice, it seems that we like organizing in that way, and we like to do business in that way, even if we have to put our trust in a central organization that makes super profits, and we don't necessarily have much of a lever of control on. And as I said at the beginning, according to experts at Davos, the platform economy, Google, Amazon, eBay, Airbnb, all of these will be responsible for 70% of the new value generated in the 2020s, 70%. And in that world, it's become clear that the current checks, balances, and controls are not enough to protect our interests. Endless data breaches, abuses of power, and the fastest centralization of wealth into the hands of a few in all of history has happened over the last decade. And in response, I predict we're going to see the gradual adoption of crypto-like technologies as a digitally native legal and financial framework for a digital-first society, economy, and business, enabling the trust, checks, and balances and rules in a way we need and should help for. Now, that sounds very optimistic, but I'm not as optimistic and doughy-eyed as perhaps I was a decade ago. about the democratization and social good that could come from, say, social media, right? The optimism and opportunity is tempered with a bit more cynicism, and the experience based on fake news, cyberbullying, data thieving, echo chambers, identity stealing, experience of the last decade, partially because of how social media technology has been used. I think a better and probably more likely characterization of how the crypto transformation, whether it turns out to be a revolution or adoption, will happen, is to see it as a capitalist reboot of the internet, like an open market reboot of the internet. Open protocols, open source, free to all is the internet we've experienced to date, but it's changing, and it's changing fast. Cryptos are made of software, they're enabled by it. In a future run by software, where all of our transactions, everything we do, from our assistants in our home to how we manage our car and everything, is run through software. Having an intrinsic financial and legal asset that is part and parcel of the stuff we build our digital society out of seems pretty obvious to me. And in the future, buying and selling, owning and sharing, collaborating over bits, if we do it digitally, it doesn't really need to be represented in separate analog paper asset forms. And we've seen with the acceleration around lockdown and COVID, the adoption of wet signatures, the movement to online communication, and this event happening right now. So whether you buy or sell pens, run a company, whether you're just speculating in the markets, whether you deal in property, whether you're a technologist, anything, I think the reason crypto and blockchain are important is this: in a digital world, in the world in which we now live, we need digital contracts and digital financial instruments and digital trust to do everything. And crypto is a pool of technologies that does this in a digital first way. So thank you very much for listening. I hope you enjoyed it and it was interesting. I appreciate there's a lot of information there. We're going to have a lot of upcoming events that you can register for, and you can inquire and show your interest via email or follow us online. I think what I'd like to do is just open it up to questions now and hear from anybody who's got anything that they want to ask. And I will do my best, if I can, to answer them.
Thank you, James. Yeah, we've got a couple of questions come through on the chat and on the Q&A. Someone, an anonymous question was, what's cold storage and how do, what's cold storage and do we/I need it?
So cold storage is a way of taking your wallet and your hash and removing it from the internet. The alternative is hot storage. Hot storage is when you when it is connected to the internet. The risk with hot storage is, surprise, surprise, because it's connected to the internet, it can get hacked into. Cold storage devices remove that, right? A piece of paper with your crypto hash written on it, that is cold storage, or you can buy a device. Do you need it? Well, I'm not a financial advisor or anything like that, but I can say that keeping large amounts of assets connected to the internet where they can be hacked is probably unwise, and having some form of cold storage is a sensible thing to do. But the most sensible thing to do is not lose that key, that crypto code. Definitely don't do that.
So hope that answers your question. And another one we got come in, which is, how might you see this directly affecting my business in short to medium time? And what can I do to mitigate risk and maximize opportunity?
What kind of, well, the question is, what kind of business is it, right? But my feeling is that all businesses are going to be delivering some of their services and products through digital mediums, if they're not already. You know, if you're not enabling and planning to do that, then you need to start doing that absolutely immediately now. You know, get somebody to advise you and to help you with that. Don't know, that might be a thing to do, but I think it's vitally important that you do that. The role that crypto plays in that, it really depends on the context and the problem that your business addresses and the solution you offer. But you know, the platform economy is coming. You know, digital is entirely normalized now. If you don't have a plan to deal with that in your business, you need to start planning for it now.
Another one from James is, what's your preferred crypto trading platform?
It depends what techniques you want to use for trading, to be honest. Some of them, like Coinbase, are quite expensive, but they've got good things like you can set up regular payments, which is a good way of putting money into it. So like, regular direct debits into it. But others have much lower costs associated with them. Now, there tends to be a relationship between the cost and how easy they are to use, and also arguably, how risky they might seem depending on where they're based in the world as well. That's more opinion than fact. So it really depends what you want to do with it. On one hand, you've got price and minimizing the cost of investment and a broad range of tools. On the other hand, you've got simplicity, but you tend to pay a little bit more for that.
I'm not sure you're going to answer all of this one, but how much cryptos do you currently own, and what are the 3 best coins to buy right now?
I'm not going to answer either parts of that. The first one, because I would never answer that. And secondly, because we're not giving any financial advice here today. If you want to look at inquiring to join an organization or to have a different chat in a different situation, more than happy to do that.
Are all these endless coins just a bubble? I mean, surely we aren't going to have a use for all of them. And what about NFTs? Isn't this just a provenance of the rich?
So digital is a provenance of the rich, right? 50% of the world's population is connected to the internet, 50% is not. So automatically, just this event is open to only the richest in the world, the richest half of the world. So, there's a truism there. However, over the next 10 years, as well as, this kind of creative renaissance we're going to have, the expectation is the other half of the world is going to come online, billions of people. So the whole global market size is going to double. So yes, there is a truth in that. In terms of, is it a bubble? I think, as I mentioned, there's going to be huge amounts of ups and downs over the period as the legislation comes in, trying to pick the winners. There are many smart people than me who will get that a lot more right than I will do. I think you have to look at fundamentals of the technology and what its use and application is. It is not, fundamentally my belief is it's not a bubble. These are the legal and financial asset tools that are available to us now that we need in the digital world. But, we don't need them all. Without a doubt, there will be a thinning out, and maybe the ones that become the biggest don't even exist yet. There are so many problems still to solve. I can't even begin to tell you how early in this process we are.
So a couple of really good questions left on the board. You kind of half went over this bit, but do you think all the new cryptocurrencies that are being created now are just trying to be the next Bitcoin, or do they offer something different, unique, more useful?
Yeah, they without a doubt offer something different and unique. They're all solving different problems in different ways. They're all focused on different entities. One that I love is called Regen. Regen pays people for carbon sequestration in their land, right? So it sends satellites over. They measure how much carbon has been adored, and they pay credits. They create crypto credits that the companies and individuals then can pay to offset their crypto. What a great solution. And there is loads of environmental and social good opportunities like that. So there are as many applications and opportunities as you can ever imagine and dream. The best thing to liken this to is like going back to 1991 and saying, do you think all the websites that are being created now are, just like the first website, and are they going to offer something different or unique? Without a doubt. Yes.
Last 2 questions. You mentioned trust. How do we know which exchange to trust?
That is a very good question. So I can tell you how you can trust exchanges in terms of the principles of cryptocurrency. So I talked about decentralization, removing a central point of failure. There are 2 types of exchange. There's centralized exchanges, and most of the big ones are centralized. And governments tend to favor those because they can be controlled and managed within a regulatory system. There are also decentralized ones, or DEX. Now, decentralized exchanges don't have a central point of failure. So arguably, based on the principles decentralized exchanges are the ones that are most reliable and trustworthy because they have those trustless decentralized characteristics. Beyond that, it is about brand and being established. I'm not going to pitch a single brand or point you in a single direction at this case. But again, it's a conversation more than happy to have in a different setting or format.
Why are cryptocurrencies so volatile? And then there's one more come through and we'll finish on the next one.
Yeah, I think they're so volatile for three reasons, many reasons, but three. One is there's a lot of speculation on them still, a lot of crypto people trading in crypto. I think a lot of activity gets related to that. The 2008 boom, there is, an established story. I don't know how true it is. That a particular well-established stable coin, I didn't even talk about stable coins today, that stable coin in its creation was kind of responsible for that boom and some of the things that they did, which might be considered, a little bit questionable. So that's one reason. So immaturity is one reason. Another is that they're not as some of them aren't as decentralized as they need to be secure. The third is that whilst there's large numbers of assets in it, compared to global markets of the world, they're still relatively small. So there's big changes. Another one is that they run 24 hours a day, so all day and all night. So I think those are some of the reasons why they're so volatile. I think it's a representation of maturity. I think over time, if you look at the theory behind this kind of stuff, that could go away.
Great. And the last one, do you think XRP will win its case with the SEC?
Right. Okay. Again, I've got no idea, but yes, I do. I think it will.
Right.
That's my view.
We will leave it there. James, thank you very much. I hope all of you have really enjoyed the webinar. And as James said at the beginning, keep an eye out for the upcoming events because this is going to be a great series covering multiple different aspects. If you have any questions following on from this, please feel free to get in contact with us.